and get in greater debt than they ever were before.
It's a little bit like hitting the lottery then, isn't it?
Exactly.
Yeah.
And so you can have a trust drafted for the children that will require them to stretch out over their life expectancy. So they get a little bit that increases over time, but it's not all out at once. And this allows that money to grow tax deferred, right? And they pay a little tax every year as they get that little distribution, and then it increases as they get to their retirement years. So that can be a huge benefit for them. Rather than all at once, it's really helping to fund their own retirement plans.
Yeah. Or if nothing else, to provide so there'll be maybe money there for their education or something like that.
Exactly. And when you use a trust, then what you're doing is, instead of the child making that decision, the trustee's making that decision. So certainly if you have, for example, a minor child, you do not want to name a minor child as an outright distribution beneficiary, because you're going to have to do a probate guardianship. You know, the court's going to supervise what happens to this money. And then when your child reaches the age of 18, they get 100% title. And what 18-year-old doesn't have lots of things to spend money on? And they don't really understand the value of capital. And so using a trustee who makes decisions for when that money can come out really can help protect your child, so the money will be there when they really need it, not just when they want it.
Okay. Can you explain a little bit about the idea of a conduit trust and how that fits into what we've just been talking about?
Sure. A conduit trust basically is special language that the IRS put in the regulations for when a trust is named as the beneficiary, right? These rules that are in the trust language that have to comply with what the regulations say allow that trust to be a see-through person, so you look to the individual and not to the trust itself. Essentially what this means is that every dollar that comes out of the plan passes right through to the beneficiary. So the trust doesn't accumulate any assets. It just becomes a conduit for how the money goes from the plan to the beneficiary. But the advantages to this, like I said earlier, one is the trustee makes the decision rather than the beneficiary making the decision. The other thing, and it's a little known rule, but when you name an individual, remember we said younger's better than older.
Right.
Well, if you name your child as the primary beneficiary and your great Aunt Edna as the contingent beneficiary, there's a little quirk in the rules that says, well, we look to all the contingent beneficiaries and the oldest one is the life expectancy we're going to use.
Right.
So even though great Aunt Edna isn't going to get the money, we're going to use her life expectancy. When we use a conduit trust, we don't have to look at the contingent beneficiaries. We only look at the actual beneficiary. And that can be a huge saver if you want to name someone maybe like great Aunt Edna later, in case your child's deceased, or if you wanted to name a charity as the contingent beneficiary.
Now, as I recall, basically for these conduit trusts, it's like one trust for the beneficiary. In other words, you wouldn't have one of these trusts where you'd have several people as a beneficiary. Is that right?
Well, what we do in our office, and this is one of those areas where the rules have kind of changed.
Okay.
But in our office, we will create. We have one master trust, but that trust is able to be divided. So you only need one language.
Yeah.
But then when we draft our beneficiary designation, it says to each child in their separate trust.
Yes.
Created under this. So each child is only going to get one trust. You don't want a pot trust. You don't want to put people together.
Yes.
But the language is just one language, and then it's applied to each of these trusts.
Yeah. And there are little conflicts related to this because in some ways probably some families would like to keep it as a pot, but when you're trying to get these advantages, like we're saying, then you don't want to have that kind of a situation. You need to sort of divide things up in order to get the benefits of the stretch out.
Exactly.
Yeah. Okay. How about some special considerations for a Roth account compared to a taxable account?
So what we've talked about so far really applies, to the taxable accounts, and that's where the majority of money is, at least right now. This year, of course, you can do unlimited conversions from taxable accounts to Roth IRAs. Paying your income tax now and then you get the benefit of that Roth conversion later. And that's really beyond the scope of our conversation.
Right.
But when you have a Roth IRA, it's not taxable when you take the money out. So in that situation, the general rules don't apply. For example, we wouldn't want to leave that to charity because there's no income tax on the kids when they get the money either.
Right.
So, and younger versus older, yeah, you get the benefit of a longer stretch out, but it's still, there's no tax. So it's a less of a consideration than it is when we're dealing with, for example, a taxable account where the younger beneficiary may be in the lower bracket as well, as they move forward.
There's a couple of other things. So one with the Roth, during your lifetime, there is no required distribution.
That's right.
And so that's for very wealthy people, this is a huge advantage. Also, the idea of accumulating assets, possibly on a tax-free basis, and then when the money comes out, no tax. I mean, it's huge. But when the person is deceased, then required distributions are there, and so people need to be concerned about that. The required distributions do apply, I guess I'll add, for like a 401k account. So what you need to do then is roll that account when you can to a Roth IRA. That's where no required distribution is required. So anyway, Ray, we're getting close to the end. Do you have any particular thoughts or words of wisdom maybe that you would like to throw out related to this as we conclude?
Yeah. A couple of years ago, I got a phone call from a woman. Her boyfriend died while mountain climbing in Thailand.
Oh my God.
And he had named his girlfriend as the beneficiary of his 401k. The problem was, it wasn't the girlfriend I was speaking to on the phone.
Whoops.
It was the girlfriend from 7 years ago when he got the job and opened the 401k account. And he never once thought to update his beneficiary designations. So it is very important. These are estate plans. It is very important that they be kept up to date.
Yes.
And, if you have 2 children and you name each child individually as the beneficiary of your plan and then have a 3rd child, that child's not getting the money yet unless you update the plan.
Okay.
So as things change in your life, you need to make sure you keep these up to date.
Okay, Ray. Thank you very much.
Oh,
I appreciate you being with me, and hopefully we'll have an opportunity maybe to talk about this or another topic again. Folks, think about this stuff. See your attorney. Get your estate plan up to date. Check those beneficiary designations. And hopefully you can join us next time on Financial Insider Weekly.